Welcome back to the channel. Today, we're diving into some crucial strategies for maximizing your tax savings before time runs out. Look, nobody likes paying more taxes than they need to, right? We work hard for our money, and keeping more of it in our pockets is always a win. That's why we're going to be breaking down some essential tax-saving tips and tricks that you can use to potentially reduce your tax bill this year. Make sure to subscribe, share, and like this video to stay updated with more valuable tips. Alright, let's kick things off with one of the most powerful tax-saving tools at your disposal: retirement accounts. We're talking about 401(k)s and IRAs. These accounts are designed to help you save for retirement, but they also come with some incredible tax advantages. When you contribute to a traditional 401(k) or IRA, you're essentially reducing your taxable income for the year. That's because the money you contribute is tax deductible. So if you contribute, let's say, $10,000 to your 401(k), that's $10,000 less of your income that the government can tax. It's like getting a discount on your taxes just for saving for your future. Now, the tax benefits don't stop there. The money you contribute to these accounts grows tax-deferred, meaning you won't pay taxes on any investment earnings until you withdraw the money in retirement. It's like a double whammy of tax savings. Now let's face it, not every investment is going to be a winner. Sometimes we experience losses in the market. But here's the thing, you can actually use those losses to your advantage come tax time with a strategy called tax loss harvesting. Here's how it works. Let's say you have some stocks that have gone down in value. You can sell those stocks at a loss and use that loss to offset any capital gains you may have realized from selling other investments at a profit. For example, if you sold some stocks for a $5,000 gain but also sold others for a $3,000 loss, you can offset those gains so you only owe taxes on the net gain of $2,000. But what if your losses exceed your gains? Well, the good news is that you can use up to $3,000 of those losses to offset your ordinary income, which can further reduce your tax bill. Now, let's move on to some other powerful tax-saving tools. Deductions. Deductions are like magic spells that make a portion of your income disappear when it comes to taxes. One of the most common deductions is the mortgage interest deduction. If you own a home and itemize your deductions, you can generally deduct the interest you pay on your mortgage. This can be a significant deduction for many homeowners, especially in the early years of their mortgage, when interest payments are typically higher. Another valuable deduction is for medical expenses. You can deduct eligible medical expenses that exceed a certain percentage of your adjusted gross income. This can include things like doctor's visits, hospital stays, prescription medications, and even health insurance premiums. Alright, let's talk about withholdings. Withholdings are the amount of money your employer deducts from your paycheck to cover your income taxes. It's important to review your withholdings regularly, especially if you've experienced any major life changes like getting married, having a child, or starting a new job. Why is this so important? Well, if you're withholding too little, you could end up owing a big chunk of change come tax time. Nobody wants to be hit with a surprise tax bill, right? On the flip side, if you're withholding too much, you're essentially giving the government an interest-free loan. It's better to have that money in your pocket, where you can invest it or use it for other financial goals. Now, the IRS has a handy withholding estimator tool on their website that you can use to check your withholdings. It's super easy to use and only takes a few minutes. Now let's talk about some tax-advantaged accounts that can help you save money on healthcare costs. Health savings accounts, or HSAs, and flexible spending accounts, or FSAs. HSAs are like having a personal savings account specifically for healthcare expenses. The beauty of HSAs is that contributions are tax-deductible, the money grows tax-free, and withdrawals are tax-free when used for qualified medical expenses. It's like a triple whammy of tax savings. FSAs are similar to HSAs, but they're employer-sponsored. With an FSA, you can set aside pre-tax dollars from your paycheck to cover eligible medical expenses. This can be a great way to reduce your taxable income and save money on healthcare costs. Look guys, taxes are a fact of life, but that doesn't mean we have to overpay. By implementing these tax-saving strategies, you can potentially reduce your tax bill and keep more of your hard-earned money. Remember, it's always a good idea to consult with a qualified tax professional for personalized advice based on your individual financial situation. They can help you navigate the complexities of the tax code and ensure you're taking advantage of all the deductions and credits you're eligible for. Until next time, make sure to subscribe for more valuable tips, and I'll see you in the next video.